Okay, has the decade-long bond bull market come to an end? Teaser, yes, it has, I believe, and I'm going to make the case for it. Highlights. The Fed is buying bonds at a rate unimaginable just a few weeks ago, yet yields are not plummeting. Not only are they buying bonds unimaginable at a level, the bond market's actually shrinking. That's how many bonds they're buying. And I have argued in the past that if this market was anywhere near normal, the 10-year yield should be at zero right now. Why is that happening? I think it's the return of inflation, or the fear of inflation after the rebound. There will not be inflation while we continue down. And the metric I'll use is the stock bond correlation has gone random. It's shifting from a deflation mindset to an inflation mindset. I'll explain that when we get there, that the whole relationship, I think, is on a change. That's going to be big implications if I'm right on the stock bond relationship changing. For wealth managers, 60-40 portfolios won't work anymore. Risk parity won't work anymore. A lot of other things as well, too. The S&P rally continues to look like a bear market rally, suggesting a retest is coming. I know that that's not a popular argument to be made right now, but it still does look like it, and I'll try and go through that as well, too. Interestingly, the S&P has retraced the most of all the world markets, and the Fed has pumped more liquidity than any central bank. I think that those two are related. And the last 2 points I wanted to discuss is at some point the economy will have to restart. People will have to go to work, but many questions remain. What will the restart look like? What kind of economic life will we return to? In other words, I'm less interested in Kevin Johnson, the CEO of Starbucks, saying 90% of my stores are going to be open next week. So what? I want to know how many people are going to be in your stores. That's really the telltale sign. This is not an economy that is waiting. I believe this is not an economy that everybody's just sitting at home waiting for them to blow a whistle so we can pretend it's January or fourth quarter of last year and go right back to where we were before. All you have to do is just open the stores. All you have to do is open the bars, open up all of the establishments. You're going to open them, and then we're going to see what it looks like. And Georgia will provide us, I think, an early line with it. Lastly, I'll leave this if I've got time, because I tend to filibuster a little bit too much. Every financial product is designed with a certain set of assumptions. Most crises result from those assumptions being wrong. The specter of negative oil prices potentially sets up the next financial crisis. Who covers the losses when prices go negative? The bottom line there is you've got a lot of things like USO, which is United States Oil ETF. If the price of oil goes to zero, USO has zero. It's lost all its money. If the price keeps going negative, there's a loss. And there's a bigger and bigger and bigger loss. Somebody has to eat that loss. Maybe the broker, maybe the clearinghouse, but somebody has to eat that loss with a negative. We have set up all of these structures in the commodities markets and other markets on the assumption that the worst case scenario is price goes to zero, you lose all your money. We have counseled people for generations, don't short stocks because you have unlimited losses. Welcome to the world of unlimited losses on a long now if you have negative prices. And I think that is where the financial crisis has come from. Financial crisis has always come from something that before it happens, if you said, hey, what if all housing prices across the country go down at the same time? People will look at you and go, you don't understand. Housing doesn't do that. Individual markets go down, but the whole housing market doesn't go down. And so this potentially sets that up. If I've got some more time, I'll talk about that. All right, let's talk about the bear market in bonds. And let's talk about what the Fed has been doing. And these numbers are extraordinary. So this chart on slide 3, the 10-year yield is in the top panel. And on the bottom is the cumulative QE purchases that the Fed has done. Now, I benchmarked it to zero on March 13th. March 13th is when the Fed announced that they were going to do more QE out to 30-year. Remember, prior to March 13th, the Fed was buying only Treasury bills, and Jay Powell famously called it not QE, and everybody kind of picked up on that not QE name. So that's why this was a little bit negative on its way to zero. So I benchmarked it to zero on March 13th. Through yesterday, the Fed has purchased $2 trillion with the T dollars of bonds in 6 weeks. $2 trillion worth of bonds in 6 weeks. And what has the 10-year yield done over this period? It's gone from 72 basis points on the Monday after they announced their program to at least yesterday when I drew this chart last, 59 basis points, and we're currently at 60. 12 basis point drop. We needed $2 trillion of bonds